I had a eureka moment. And that was, wait a minute, you've been a student of disruptive innovation all your investment career. Why don't you go out and disrupt your own industry?
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. This week we have another replay from the ETF Experience. This episode was easily one of my favorites, with Cathie Wood and Tom Staudt of Ark Invest. What I loved about this show was that we focused on how Cathie launched a company and how she got through the early struggles to will the success of the company. You'll hear Cathie describing how she went on long walks, racking her brain, trying to figure out how she can make the company work. Success looks guaranteed in hindsight, but at the time it was a lot less certain. Well, at least in other people's minds, but never in Cathie's. For context, this show was recorded in June 2019, after Ark had become profitable and already an outlier success, but before she would have the exponential success in late 2019 and all of 2020. That was to come. I want to add a few other reasons why I'm posting this show and why I am rooting for Cathie and Ark. Ark has become a true lightning rod in the industry, and it has become so because of the courage of Cathie's conviction. I respect that. For me, it's not about her investing style, but rather her conviction and long-term outlook that I admire. I find myself leaning far more towards global macro and value for my own investing style, but who am I to even say that when she's been right for a really long time? Respectful people can respectfully disagree on stock valuations and still admire how they go about their business, which brings me to my next point. Some of the vitriol directed at Cathie online is way, way beyond the bounds of what is appropriate. Never mind the fact that she's a female portfolio manager in an industry with an embarrassing lack of them. And by the way, I've never even heard her point to that directly. But just as a person, if you disagree with someone's investment philosophy, that doesn't give you the right to be an asshole. I understand many investors have struggled the past couple of years, the market being manipulated by the Fed, the disconnect between price and value, gamma squeezes in tech, nothing is trading as it should, and her performance breeds jealousy. But some of what I've read online, directed at her specifically, is just beyond inappropriate. Finally, she's kind. You'll hear on this episode, she is a kind person, generous of her time, and just a good person. So I hope that this episode gives people a better understanding of what she went through to get Ark going, that it wasn't so easy from day one, and people can better appreciate the story behind the company. This is a very special episode. There are precious few people who have successfully launched ETF issuers in this competitive environment. There are even fewer that have really done it their own way, following their own script. So I'm very honored and appreciative to have Cathie Wood and Tom Staudt from Ark Invest on the show. We're going to hear about how they did things differently, how they pulled it off. Catherine, of course, is the founder, CEO, and CIO of Ark Invest. And Tom is the COO of Ark Invest. Cathie, Tom, thank you for joining the podcast.
Oh, thank you, Phil. We're really happy to be here.
Thank you.
So for me, I'm in the trenches, and we're a few years younger than you guys as a firm, and we've had some ups and we've had some reasons to pump our chest and celebrate. We've had some downs, and we've had some instances where we haven't had the growth that we anticipated in the first couple of years. When I look at what you've done, you and I'd say Meb at Cambria as well, really the two people that I think have really created their own roadmap and done it their own way, and it shows me that it can be done. And without that, I don't know. I'm just that type. I have unfinished business. I'm never going to give up. But it's been very helpful to me to know that this is achievable. So I was hoping to talk more about the business side and the early days and getting through all the clutter and getting to critical mass. If you don't mind, let's start with the Ark origin story. I mean, how did you go from, I believe you're at AllianceBernstein, but how did you go from the corporate environment to being a startup? How did you two, Cathie and Tom, come together? And what did the earliest days, the pre-launch days of Ark look like?
Well, as you know, I started the firm to focus only on disruptive innovation, and it was because of what was happening in the traditional world that motivated me to want to do this. So I saw the move toward benchmark sensitivity everywhere. And it was because of the tech and telecom bust and then the 08-09 meltdown. And so this risk aversion, both career risk and business risk, became endemic to traditional asset management. So as I was asked, or as it was suggested by quantitative research experts that we risk complete our funds at AllianceBernstein. I said, I would be happy to do that with sister products, but those who own our current funds know what they own, and they know it's volatile, and they want volatility because there are two sides to volatility. You're concerned about the downside, but there is so much concern out there. What about the upside? Volatility in an up market is a very good thing. So we saw the desire for that kind of risk disappear, I think, from traditional asset management. And especially because the largest asset managers out there with the clout, they started looking for innovation in the pre-IPO space. So there became a void, and what I believe is a huge unmet need to be fulfilled out there. And that is always a good reason to start a business, especially because it was becoming impossible to do it as risk aversion increased with the bull market extending. So I knew there was an unmet need out there. And I also, at the same time, this was in August of 2012, I had a eureka moment. And that was, wait a minute, you've been a student of disruptive innovation all your investment career. Why don't you go out and disrupt your own industry? Use the technologies that you have been investing in to disrupt it. And so this ecosystem came to me. Yeah, why don't we harness social media? Why don't we do some crowdsourcing? And why don't we give our research away so that we can engage with the communities we're researching and actually become a part of those communities? And why don't we do that? Because no compliance department in the country will let its portfolio managers or analysts do this. They can look at social media, but they can't say a thing about their portfolios or their research. And to this day, that is true. So I felt we would have a huge competitive weapon. And then the third component of the research ecosystem was, hey, why don't we invite domain experts like professors and I thought venture capitalists and entrepreneurs, those who are interested in pushing the frontiers of knowledge forward as fast as possible. Why don't we have them become a part of our research ecosystem internally? And they can battle test our models. They can take them into their classrooms. So ping, 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 all of these ideas rushed at me in August of 2012. I became very excited, and I just knew I had to do this.
And Tom, how did you find Cathie? How did Cathie find you?
Yeah, it's interesting. It turns out that the chairwoman of our independent board for the ETF Trust is also a board member at Syracuse University. Her son also was a student. And so through that connection, Cathie was introduced to a director of a program where I had completed a degree. And after meeting with Cathie, suggested, certainly in the early days of building a firm, that he had a couple of students that should meet her. And so he also contacted us on our side, and me and one other person came down. We came to New York. We met Cathie. At this point, I think it was just you and one other person. I think it was just literally two people. Effectively, the first thing we did is we heard the pitch. So we heard her present to a group to really evaluate. And then afterwards, we were going to talk to both of them about potential openings. And so the other person was a friend of mine, had been a good friend of mine in the program at the same time I was. He got to go first and came back from having lunch with both of them and said, there's good news and bad news. The good news is I got the job. The bad news is I have no idea what that means for you. So that was kind of the backdrop in which I really met Cathie, is just hearing that I was now going to go basically interview with her for a job that had now already been filled. I got coffee with Cathie. He got lunch. I got coffee before I drove back and left New York. And it was during that time that I think the two of us kind of started to talk it out. I heard more about the pitch and the idea from her side, and I told her many things of where I thought I could add value to that process. And obviously, I must have done a good enough job talking myself into a job that didn't exist at that point. And actually, the first person is Sebastian Bankert, who's our current chief marketing officer today. And so he's still with the firm 5 years later and have been along for the ride, and I'm glad that I'm there as well.
And I'm going to backfill this a little bit. So I met Professor Massaclat, Steve Massaclat, at the Newhouse School of Journalism, which is part of Syracuse University, through our chair, Darlene DeReamer. The reason she wanted me to talk to him is, this was before I started the firm. She said, why don't you battle test this idea on Steve? He's the head of the master's program in new media management and data analytics. So he gets pitched all the time. And so I said, okay, great, I will. I gave him the pitch over the phone. And he said, you have to do that. He said, no one's doing that. It's a brilliant idea. Do it. And so that was just such validation when most people thought I was crazy. Most people said, what are you doing?
So this is 2014.
That was 2013. 2014 was the story Tom told. He asked me then to present to the spring break seminar in New York City to all the students. And so that's when, as Tom said, I gave the pitch. And the interesting thing about, yes, Sebastian got the job. And yes, the consolation prize for Tom was coffee. However, what was interesting during that moment, and I think you have to do this as a CEO, I was basically thinking aloud. It was stream of consciousness, okay, to get this company going, we're going to have to set up a back office and a trading system. And every time I said something, Tom nodded and smiled, saying, yes, I can do that. I can do that. And of course, he had never done that, but
when you know you didn't get the job you're interviewing for, it seems like such a bad time to tell her things you couldn't do instead of things you could do.
By the way, he was at Cornell at this time. He was getting his MBA, and he had to go in front of a panel of professors with his job prospects, one of which was Ark. And I'll let him tell the rest of that story.
I think that board was certainly surprised to see this offer versus other opportunities that I had. But I will say, when I put my offer letter from Ark to some of my trusted sources that were reviewing and thinking about this, and you're a CEO, Phil, so you can appreciate this. At that point in time, Cathie still wrote the offer letters because it was effectively Cathie and one other person. And the person told me, I've never seen an offer letter for a job filled with exclamation points all the way throughout. That Cathie Wood is the only offer letter that they'd ever seen with just riddled with exclamation points. And they said, you might want to take that seriously because there's obviously a lot of conviction in this letter. And if it's true for that, it must be true for everything else. And that certainly was true. Of things to come.
That's fantastic. And I think people that are listening, when you hear the story now and you say, Cathie, well, you told people, everyone said you're crazy. I think we got to take a moment and just kind of reflect that in 2013, 2014, there were active ETFs, but it wasn't really a thing. Conventional wisdom, you can't do active in ETFs. Nobody was talking about active share, and it's certainly not as a positive thing the way it is now. At the time, that was called tracking error. It was a negative. Nobody was talking about innovation as a category. Innovation was a buzzword people threw around. The idea of the transparency and the research. Hearing it now, you've normalized a lot of this stuff. Your success has normalized it. So a lot of people might not really get now how novel it was at the time.
Right. My first exposure to a group of people who were passionate about ETFs was the Morningstar conference in October of 2013. And on the stage was Eugene Fama, the grandfather or godfather of really passive investing. And at that conference, I remember he said, active management is going to die. It is going to zero, which I kind of thought was impossible. And I thought there would be some pushback in terms of Q&A. No, applause. And I said, I'm the only active manager here. It's clear. And so, yes, it was a bit shocking to me that I entered a part of our business. Remember, I'd been in the business since 1977. I started in college as a junior. And I had a very wide network in the business. And I had a lot of people who respected the way we were doing things, and we were pulling away from the pack, and even more so as passive was gaining momentum. And I did not understand that I was moving into a sphere where my network would have zero influence, none. my power base, if you might say that, was going to be absolutely worthless. Worthless. I did not understand that. And so for the first 3 years, if we start when the legal costs started, I supported the company for 3 years by myself. That's how much conviction I had. It took so much longer than I expected for this to play out. And just like almost anyone who starts a new business, we had to pivot. We had put ourselves forth first as an ETF provider because we thought that's where the puck was going and it was growing so quickly. But what we should have done, first and foremost, is saying, our focus is disruptive innovation, which it was. That is why I started the company. But we didn't do that. That was a mistake. And so we corrected that mistake. But we also pivoted in terms of wrappers. We said, okay, we have to be wrapper agnostic because first and foremost, the huge unmet need out there is disruptive innovation in the public equity markets. It's inefficiently valued and researched, and we can do that for you. Not until we made those two pivots did we find...
You can do that in non-ETF wrappers, in SMAs.
Yes, SMAs. Today we run almost $8 billion, 3 of which is in the ETF wrapper.
You have the thesis and you meet Tom and the rest of the team and everything comes together and you're there and you've got all the conviction, you're funny, you guys are ready to go and you launch and you're waiting for the fireworks to go off and the assets to skyrocket. And doing a startup, I've come to learn, requires more patience than most founders have. You're talking about a group that is by definition impatient. What was that like? I mean, did you have doubts? Did you have a moment where you're like, what am I doing? Did you just have confidence all the way through? You knew where it was going to end up?
I never had a doubt about the disruptive innovation part. What I did say to myself 2.5 years in was, what are we doing in ETFs? It's clear we don't even speak the same language. Nobody understands what we're doing. And by the way, I was funding this ecosystem myself. And after year 1, when you get all the breaks, that second and third year is a killer, right? And so the question occurred to me more than once, and Tom can, I think, corroborate this. I never doubted that we would be successful. Now, were there days when I walked home when we were still $20 million AUM? That ended roughly in March of 16. So we started in October of 14. Were there days when I walked and I was just saying, okay, there's got to be a creative way? I was always thinking, no, there's got to be a creative way, got to be a creative way. Those two pivots were important, but I was continually thinking, there's something we're not doing that we need to do in order to communicate our message, because I know people need what we have. And what was also going on at the same time, I had never been through a period of more risk-off, risk-on environments. I mean, just whips. And of course, in our strategy, in a risk-off period, we will underperform at the start of it. We tend to outperform toward the end of it and certainly coming out of it. But it was stop, go. We didn't get to show our stripes really until late 16, 17.
And how about you, Tom? Were you like, oh man, I should have taken those other opportunities? Or were you, did you know that you were in the right place?
There's two things that stand out certainly from that period. I think one, and I will corroborate that Cathie didn't doubt, or if you did a heck of a job of never showing it, the investment thesis, that the products and the process. And so you knew, you had confidence that the area we were focusing on, that there was a high degree of conviction and consistency there. I think one of the things that gave me confidence on the other side of the table is that we would have active discussions about how do we pivot while staying who we are. And I think that is one thing that can be very challenging for entrepreneurs, is they have such a conviction, such a belief that you see firms that are so close, but they don't make the small pivot and they don't reach their potential. And their history is littered with those examples. And so the fact that we were actively discussing about how do we make a pivot without losing our identity was always encouraging to me, that those were the meetings we were having. And I think that it was kind of the idea, you have something, but as Cathie said, but we're missing something. And so how do we cross that bridge? In terms of getting to that point, though, from the other side, we had to show a level of consistency and confidence in terms of making sure we were running smoothly and operating. We were doing all of that right, while also spending the other half of your brain saying, okay, now I know we're doing that right. Where's the part we're getting wrong? And so it's one of those interesting things you talk about when you're trying to do something different. We talk about all this all the time from the investment side. The risk of an innovator is being too early, right? Or is it too early and from a stock price, is it too early and did you overpay? But from the too early side, it's how do you buy time or how do you accelerate effectively people recognizing what you're doing? And yes, I agree. People weren't talking about innovation. They weren't talking active. It's funny because I still have in files old marketing materials, and we used to say Ark Invest, the active ETF shop, as if that was in and of itself enough, right? Like that was a huge selling point. And so focusing on doubling down on the innovation, which was always key to what we were doing, I think was really critical. And then allowing ourselves to find those other avenues and grow it. If you build it, they will come. It's if you build it and consistently message it and work over time and then figure out how to distribute it, then they'll come kind of approach.
I mean, it sounds like you were rewarded for the expertise and the focus on innovation and the different areas in your research, but you were not rewarded for using the ETF vehicle. And you compare the ETF vehicle to, I mean, certainly, obviously a hedge fund. We managed a hedge fund. We've since closed it down. But the lockup period, just trying to get them liquidated, get their money out is, I mean, everyone talks about, 2 and 20. Well, most people aren't getting 2 and 20 anymore. Forget about 2 and 20, forget about the fees, just the lockup, the lack of transparency, the opaqueness. I mean, there are so many reasons. You look at the mutual fund side. The mutual fund companies don't have to show their daily inflows and outflows, which to me is my ADV, and I get judged on that. I've got buy and hold sticky funds. These aren't tradable products. And people say they're illiquid. Well, they're not illiquid if they're managed well, and I believe our funds are. You use the ETF vehicle as lower cost. You don't have a 12B1, so you don't have a way to incentivize distribution platforms to use your fund. You would think that would be rewarded by investors, but in fact, in my experience, it's actually punished.
I think if you think of the shape of our growth, if we just started in a mutual fund wrapper, or maybe a separate account, but let's say mutual fund just for the retail audience, I think we would have had a lot more assets early, but that we probably wouldn't be where we are now. So we would have been rewarded in the short term, but not really long term. We would have had a much lower ceiling. And I think that when Cathie talks about one of the pivots, one of the things that I think that we did right is recognizing that in this industry where there are much larger firms with much longer businesses, with bigger marketing budgets and brand names, people had to know what we were and why they should pay any attention to us. And by focusing and messaging around disruptive innovation and staying true to that, not worrying about the wrapper as much, ETFs clearly we think are a great vehicle, beneficial to investors, and are very important to what we're doing. But by focusing less on that and really branding as innovation, what that did is, why would you look at Ark instead of look at insert your big bank here? Like, why? Why should I even care about that you exist? And I think we did a really good job, and Cathie made sure to reinforce to all of us that we're going to double down on this. And so when you think of innovation and technological innovation, we're going to be into the conversation for who you think of, because that's why you're going to think of us. The rest of it doesn't matter. And I think that's what allowed us to get over the top, not the vehicle. And then the vehicle then ultimately was the thing that put it over the top.
And that's not just a marketing, that's not just a branding thing, that flows through. I mean, high conviction trades, concentrated portfolios. You guys are early on Bitcoin through GBTC, which is flawed, but it's the best you can do in an ETF. And everyone said at the time about your GBTC bet, the same thing that they're saying now about Tesla. Oh, you're live and die by this call. Well, in fact, you have several areas of innovation. Well, you could say it better yourself.
What's interesting about this is while I was saying, oh man, why did we start in the ETF wrapper? It's the best thing that happened to us because we were so visible and out there and everybody was sure we were going to fail. They were positive we were going to fail. And so it's kind of been like this all my life. When I was really young, nobody thought, as you know, college, if I'm telling you 70s, you have a good idea of how old I am. So in those days, if I walked in with a notepad, I was the secretary. But I wasn't the secretary. I was quite happy to get people coffee, but I wasn't the secretary. So they were shocked when something smart would come out of my mouth, or that I'd even talk at all. And I think when you do this head fake, which is effectively what happened here, everybody was sure we were going to fail, and we didn't. And so now they're paying much more attention to us than probably would have been the case otherwise. Now, as far as the Bitcoin, you're right, but they weren't even that kind to us and saying, you're betting your company on this. They actually were saying, and some of the finest journalists out there in the ETF space were saying, that is nothing but a marketing gimmick. And, putting us down for it. Whereas we were writing, we had white papers up on our site. We had done more rigorous financial and theoretical analysis than anybody else out there. And it was there for everyone to see. But just like it is with Tesla today, they just basically drew their conclusions without really looking at what we were doing.
So the research that you've put out there, the research on Bitcoin, the research on Tesla, you put a valuation model on Tesla public. When we just talked about how the transparency of the ETF is not necessarily rewarded the way it should be by investors in some cases. Well, the research that you put out there, you're transparent on a daily basis. I'm signed up. I can see your trades every day. It's unprecedented on several levels. You guys have rewrote the rules on transparency. So you got the daily trading, the valuation models, the research, your thought process. Obviously, the holdings are transparent on a daily basis. That's another thing that you would think would be rewarded by the market. And there's been a lot of criticism online from different people. And I wonder, do people appreciate, one, the guts, two, the work that goes into it, the work that you're willing to put out there that is probably not done by the people. The reason why people are not transparent is probably more to hide than they have more to show.
Thank you.
Yeah. And is that something that you feel like, do you have any second thoughts feeling like, well, instead of being rewarded for taking this step towards transparency, we have to take a lot of shit over it?
Well, I don't regret it at all. And we're actually becoming more transparent over time. So we put the Tesla model, or large parts of it, up on GitHub so that anyone who wants to change a variable because they just disagree with us can change it and see what answer they come out with. What's great about that, if they do that, and we're getting some very thoughtful responses and people who really want to help us on GitHub as opposed to Twitter being not as productive, shall I say, kindly. And what I think people, when they experiment with our model, they actually are learning that, wow, this thing is highly undervalued. If you really go through it and toggle through and understand why we have exponential growth in electric vehicles, if you buy into those, there's no way you can poke a hole. You can poke holes into certain parts of any model, right? But I think we want to continue to publish models like this because there's so much exponential growth in the making now. Like we haven't seen since the late 1800s, early 1900s. We really believe that. And therefore, that's why the mindset is not ready for it. We really want to make this part of the market more efficient and to expose people's portfolios, investors' portfolios, to these amazing opportunities, at the same time warn them what they have in their traditional portfolios increasingly are value traps, many of them, because of these 5 innovation platforms evolving at the same time.
What's a value trap?
A value trap means a stock is cheap for a reason. The company is being disintermediated, disrupted. It's going to lose its market share. It's going to lose its margins, something like that, because of innovation. When I was at AllianceBernstein, I'm going to give a shout out to Lou Sanders. I don't know if you know his name, but he was the CEO of Sanford C. Bernstein when Alliance bought it. And then he subsequently became CEO of Alliance. And so he's a deep value investor. He's brilliant. He actually helped us understand this concept. He said, I know that my biggest risk as a value investor is a value trap. I want to meet with you every 6 weeks and brainstorm what these innovations are all about. That was such high praise and gave me so much confidence that we were onto something big as we were surfacing one after another how close we were to the tipping points of these new technologies and how explosive they were going to be. So we think banks are going to be disrupted big time. They're cheap for a reason, right? Everybody's saying, oh, they're below book. Guess what? They're cheap for a reason. They're getting finteched out, they're going to be finteched away. And you've got the online banks like Goldman's Marcus now just going for their heads, in terms of the energy completely disrupted in the world we see. Autos completely disrupted. Rails disrupted. It's going to, when autonomous truck platoons take off, they will be cheaper to transport freight than rail. Right now, they're 3 times more expensive. They're going to be cheaper than rail. So the reason we want to educate is we can be a great complement to traditional strategies. We're a hedge. You may not believe that we're right, but if we're right, you're in trouble. And so use us as a hedge.
You said early on that almost like a point of pride that everyone thought I was going to fail. Everyone thought you were going to fail, but you knew that you weren't. And you just alluded to now on Twitter, I've seen vicious attacks on you guys on Twitter. How do you deal with that? Do you ignore it? I wouldn't be able to deal with it. And you seem not the slightest bit deterred. And, I think you handle it with a lot of grace. Is that because you're just not reading it?
So what I've asked marketing to do is go through the tweets, the responses, and flag anything that I should take seriously. They don't flag a lot. So there's a lot of venom out there, and it's personal, and I don't understand it. But, I've had to be this way all my life in terms of investing. I've had to have a hard skin. And again, being involved in disruptive innovation as long as I had, I'm used to this. This is just taking the pushback. What's interesting is the pushback is very visible, whereas within investment firms, people wouldn't tell me what they thought. They'd tell each other what they thought. At least I know this is straight to my face. And that's okay. It's transparent. Fine.
The tone of it is different than, I don't know if we're going to bring up the whole male-female thing, but I wonder if that's a thing. You probably don't want to go there. So.
I've dealt with that all my life too. I say this in terms of investing all the time, no matter what. If a stock is under assault, I say, based on the courage of conviction, because of our research, I say truth will win out. Whenever I'm facing a huge amount of negative sentiment, it actually gives me strength. It gives me strength because often I can tell from the comments they're not well informed. They're emotional. We are not emotional. It's interesting for me to be saying that in a way, but we are not emotional. We are very disciplined in terms of our buy and sell points. You'll see us trading around opportunities. We got all kinds of flack in the fourth quarter. I'm a portfolio manager. That's what I'm supposed to do, trade around these opportunities, because I know controversy will give us more opportunities with the stocks we think are the most attractive.
In a place where you have active versus passive debate, I think the entire debate is misframed to begin with. But if you're going to hire an active manager, you want to have the active manager who has that confidence and has the conviction. Wouldn't be a very good active manager if basically would make decisions based on social media or where the winds are or popular sentiment. I actually think it's an excellent example, just in general, from an active management standpoint, of the criticism is actually probably a good thing because you understand what's priced into the market. Yes. It demonstrates our conviction is not something that is influenced by anything other than the research and fact, and that sometimes people agree, sometimes they don't, but that's also what makes a market.
It's so interesting. Just in the case of Tesla, I can tell you, because of the kind of research we do, these downturns in the stock, bear raids on the stock, as we've seen in the first half, but these bear raids actually are soul-searching times always. You can't assume 100% that you're right, or we can't assume 100% that we're right all the time. We cannot. What are we missing? What are we missing? And so Tom makes a great point. Because all of this is out in the open, I see that this is another Amazon situation. I face the same thing with Amazon. If Twitter had been a thing back then, I'd have been the most trolled portfolio manager in the world, just like I am the most trolled portfolio manager in the world because of Tesla. But back then it was whack-a-mole, just like Tesla is. Whack-a-mole. The street didn't like something. Amazon changed that. The street went on to something else. With Tesla, it's production. Then it was demand. Then it's cash and balance sheet. And now it's back to demand. There's always something. But you know what? If they have to search out the new thing to be bearish about, that gives us increased confidence.
But that's the confidence is really the most amazing thing. Most active managers will shy away from those big, bold calls too. People talk about closet indexing, and most active managers will filter and tilt, but they won't make that level of call. And so much conviction in your models and your signals and the thesis and the research that you've done. Is that just a product of the research that you do? So you're a quant and the model is what it is and the output is what it is and we believe in the work we're doing? Or is there something like, where does that level of confidence go? Because it is very uncommon in this industry to have that level of confidence, forgetting about the criticism, just in the face of the market going up and down, and days it goes with you and against you, and everyone battling the same demons when it comes to conviction on a trade.
Yes. So the conviction definitely comes from our research. We have the best research in the world on Tesla. I believe that, whether it's on batteries, on artificial intelligence, on just the exponential growth curve associated with Wright's law, which we can get into. you. We have a differentiated way of doing analysis, which works. It works. But the reason we're doing it and others don't is you have to have a long-term time horizon. Our time horizon is 5 years. Most analysts can't afford that luxury because of how their incentive systems are set up. Our incentive system is a 5-year time horizon. So I think we have a competitive advantage, not only in terms of living in the communities we're researching and getting superior information from them, not inside information, just superior information, because they want to talk to us, because we're looking at the world in a way they're out there innovating heads down, and we're giving them perspective saying, hey, your world is going to be this big, and here's where we think the economics are going to reside. Are you in the right place? And so it's very powerful to have not only our own internal research, but now all of this ecosystem around us, either pushing back. I would consider Twitter generally pushing back, and that's fine. Seeking Alpha is pushing back. They take our research and push it. But what does that do for us? We get to see, okay, what are their assumptions? Have we thought this through completely? So the soul-searching exercise forces us to go back to all of those who think, and if it's just even today, Goldman cut its price target on Tesla. It's had a run. It's hurting the shorts. I'm not going to say why Goldman chose to make but they're saying nothing new. They're saying, oh, there's a demand problem. It's not in the second quarter. It'll be in the second half. Well, please. So if they're saying nothing new, they're not adding anything, we don't worry about it.
How do you maintain a 5-year or a longer-term time horizon when obviously, you have to have clients calling you up if you have a down week saying, oh, what's going on? Or, at least a down month. How do you maintain that longer term horizon in the face of pressure from your investors?
Well, the first thing we do when we are talking about what we do and educating our clients, and I credit our distribution partners, but they've helped carry the message, which is, this is the closest you'll find to a venture capital fund in the public equity markets. And you have to have that kind of time horizon. So we have been really gratified. If you looked in the fourth quarter, our redemptions were few and far between. In fact, we've had very little in the way of redemptions in our ETFs. I'm very gratified with our distribution partners and with our own education efforts.
And I think it kind of ties the last two questions together. I guess that I believe that some of those social media critics, I think is how you call them, I think they're trying to hurt us or think they're harming us or something along those lines. The irony, and it kind of goes to your question about portfolio managers who don't like that type of scrutiny or criticism, is that type of pushback actually helps us. It makes us better because we have to ask ourselves the tough questions, and our analysts and our portfolio team effectively take those questions, take those criticism and put it back into the model. And it's during those periods where our research gets even stronger and our convictions grow even higher. And so what people are attempting to do to hurt us is in fact benefiting all of our investors and making the firm a better firm. And I think that some of the criticism of active management is that places where they have struggled is because they got into an echo chamber of yes people. And so it was, you didn't want to face the criticism, so you didn't face it at all. And I think the problem with that is that you've seen that also play back into some of the returns that active managers have had as well, because they didn't face any criticism or challenge, and then it didn't get incorporated. And so, I mean, people can certainly feel confident if they invest in our strategies that we have faced those questions. We have faced that criticism, and the conclusion in the resulting portfolio is that. And then to finish that off, we're going to be very open in terms of talking about it and educating. And so a lot of that is done on the front. And so, yes, if we have a bad period, the trolls might come out, but our investors already knew what we were doing and understand that we're going to communicate. And they didn't buy it, by and large, they didn't invest in it in the first place if they weren't already comfortable, because we were very clear about educating about what the strategy would do in the first place.
You know, one of the things I think that many people, this is not an investor thing or an analyst thing, many people don't like to be laughed at, made fun of, trolled in this case, memed, which I have been memed, which is crazy.
They don't meme a $2 million fund, as a measure of success.
But I'm used to it. As I said, I've been through these cycles, so I know the psychology. It strengthens me, and I never mind it. You were very kind to say, well, they're a little much on Twitter. As I said, I have our marketing department sifting through to just make sure I'm not missing something important because I don't pay attention to them. I honestly don't. I was just criticized. The only reason I knew about this is someone I follow liked this criticism, which, by the way, is a seasoned portfolio manager, a CEO of a company, a person to whom I have talked. And he liked this venomous trail. So it's the first time I don't look at this stuff, as I said, but he liked something. And I was saying, okay, what are they saying here? I was being accused of being a liar and a fraud.
It is a little bizarre and excessive. It's different in this case. But look, the market's going through consolidation. People are having a hard time, and you guys have mopped the floor. Your performance has been off the charts. You're exploiting the VC premium in the public markets, which nobody's doing. And that allows you to look, because VC funds aren't marked to market daily. And even if they're marked to quarterly, it's like half the valuations are made up anyway. Right. So you can have a longer time horizon. And that's what you need for some of the companies that you invest in to really reach their maturity.
Yes.
Let's fast forward now. So we're back to present day. And now you've had some success. And here come the copycats. Mm-hmm. And I've seen all kinds of copycats, some using some of your messaging and language, some not. And most recently, iShares does what they do. And they've listed funds that are extremely similar in theme and narrative or messaging as what you do. Does that bother you? Is that something that you anticipated, that you kind of knew was inevitable?
It doesn't bother us. In fact, Robo, I think, was started around the same time we were, right? A little earlier. So, no, it doesn't bother us. They're not doing the research we are. I consider them, Tom will speak to this in more the business side, but from an investment point of view, I don't consider them competition at all. Now, from a business point of view, Tom will say they are, and they are from that point of view. But from an investment point of view, they are not doing the research we are. The idea that you can have an indexed fund associated with innovation, well, indexes are where they are because of what has happened historically. We have no index as a screen. Our research is our screen. And we are very forward-looking. To be rebalancing an index for innovation means you're going to miss a lot of alpha while some of these big ideas are not in indexes. Tesla's not in some of the major indexes because it hasn't had a 4-quarter moving average of being profitable. They're not going to include it if they're using that as one of their screens. So they're not doing the research. And the whole concept of indexation is somewhat problematic when it comes to innovation. But I'll let Tom go on the business side.
I think what's really interesting about it is that we had journalists and others who kind of were looking at our business plan and effectively asked us that question of, if you manage to get some traction, won't that be the kiss of death? Because then these bigger firms will come in and just copy it and put you out. And I think what they didn't realize is, one, is that if that's what these firms were trying to do, they inadvertently validated all of the spaces that we're in. And so now they've given any investors who are on the fence on the themes and the elements and the topics that we cover now have a great deal of confidence in these themes, because every big name firm, or many large platinum existing brand names, suddenly now have funds in these spaces, which inadvertently told all of these investors, you should have exposure to all of these spaces. So I appreciate that. It's actually made my job a lot easier in that regard. I do think it's really interesting, though, that for the number of copycats, and there have been some very large brand names, not one of those large brand names has done so in an active management format. Every single one has been by writing an index or by buying the rights to an index. And so it's like they kind of want to copy us, but they're not really willing to commit all the way to trying to do it. And I think that in some regards, we talk about this in our portfolios of the companies that we have, that sometimes it's difficult to make new markets. You're effectively making a market out of a space that doesn't exist. And one of the challenges for that we faced is that people didn't know where to put it or what to compare it against, or how do we know if you're any good at these spaces we've never looked at before. And this is true even from the research departments of very large wealth management platforms, from the wirehouses. Well, by having these other competitors come in, they now have first of all, there's enough funds for them to actually look at the space and evaluate them. And we're highly confident that we'll stack up well against these competitors. So now it's forcing them to look at, to rate, to make available. And so I actually think it's helped us, not hurt us, even though everybody anticipated that because we were small and they were big. But the other thing is, while validating the space, I don't think most investors associate these type of spaces with the brand names of the firms that have come in to try to copy. Their brand names carry a lot of weight for many things, but this isn't the thing. And so we talk a lot when we think about product development, it has to be the right strategy with the right firm, with the right distribution channel. And if you have only two of those three, it's a very difficult battle, because we could have launched strategies that might have done very well raising assets if it was under a different firm, but people don't associate us with it, and so we would struggle with it, or our distribution channel would struggle with it. I think that some of these large firms that have tried to launch funds in our space that have actually really underwhelmed in some regards in terms of the assets, I think they're starting to figure out that just because I have a really good brand name in something else, indexation or commodities or broad market or international or something else other than this, doesn't mean that name translates. And they're not spending their big marketing dollars on putting these because they have 100 other funds in more important or bigger areas that they are known for. And they're not going on into the media, and they're not releasing research, and they're not participating in social media. And so I think it's actually helped us, not hurt us. I get the question a lot. I do think it's really interesting. None of them did it in an active format, at least to date, or not really. But I think by and large, it's been a good thing. And it does force us to continuously push ourselves to be better. And in any industry where there's no competition, what happens is that results start to get sluggish. I mean, that's true through all of history. Monopolies are not necessarily good for customers. I don't think it's exactly that dynamic, but it does always make you better when you face competition. I think that we have tried to really internalize that and challenge ourselves as well.
Yeah, and look, people could take the individual themes that you have, you break down into the 5 big ideas. People can build something around that. People could build something around the overall theme of innovation. But the harder work, it would be a lot harder to build based on the research that you guys have, and starting with the research. And you're right, nobody has done that. There's nobody else in the ETF space that is picking stocks based on fundamental research that they're doing in-house, forgetting about the transparency and all that, forgetting about Wright's Law. I mean, just the research part of it, which has been a major part of your success. You're right. That's the one thing that nobody's copied, because that's the harder thing to do. It's too hard. It's easy to, yeah, you're right.
Right. They're doing research, they would say they are, but it's all quantitative. So it's screening. And from our point of view, that might be good for many strategies, but when it comes to innovation, it's not a good idea.
Our funds are all quantitatively screened. We don't have any active discretion, but they're different. One is exploiting a proprietary data set that we have. The other couldn't be more simple. It's the reciprocal of the market cap of the S&P 500. That's the appropriate structure, in my opinion, for those strategies, but it's completely different than what you guys are doing.
What's interesting is that when most who would start a firm in the investment space for an active manager would have a portfolio manager, and then they would spend the capital that they had available on marketing and sales. So really putting it into the distribution. And then if they raise some assets, maybe they would bring on some more analysts as it permitted. And I think to kind of go full circle from when you were asking how the firm started versus these challenges now and these opportunities now, the one thing that we did is we flipped that completely on its head. We invested in the research and analyst team first and really didn't have the sales and distribution team until we had a proof of concept, till we had a book of research, till we proved that we can produce unique and differentiated research and turn that into stocks and turn that into portfolios. And then we brought the distribution and sales on. So we did everything in the reverse order. But I think that that's really been key because, as you said, that's the area people have not copied because most would not be willing to do it in that order because you have to effectively have such a degree of confidence that you're willing to play the long game on your own firm from the beginning, and most don't do that.
I'm going to add one thing on research. First of all, Brett Winton is our director of research. We've worked for more than a dozen years together. But what we've also done is created a research effort that is not sector-based, not industry-based. It's innovation platform-based. And those innovation platforms, so DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, which are supporting 14 different technologies, which we don't have to get into, those are converging. So let's go back to Tesla, because it's We can't avoid it. You talk about autonomous taxi platforms. That's where Tesla is going. Think of that. What kind of traditional analyst out there is going to follow this? The ones who are following it are auto analysts. Think about this, though. Is their world robotics, autonomous vehicles or robots? Is their world energy storage, battery technology? No. Is their world artificial intelligence? They're not comfortable with technology. The auto industry hasn't changed in 100 years. What we have here is the convergence of three major multi-trillion-dollar innovation platforms into one of the most important investment opportunities, I believe, of my lifetime. And I think genomics rivals it, given how important it will be to human health. But I don't think research departments today are equipped to handle this. And that's the other competitive advantage we have, not to mention the broad research ecosystem we have out there, meaning the innovators out there that are part of our network.
Well, congratulations on your success, and thank you for coming on the podcast and talking to us. Thank you, the listener, for your time. Please share the podcast. Please subscribe if you aren't, or give us a good rating. We'd appreciate that. Happy trading to you all.
Thank you, Phil.
Thanks, Bill.
Thanks for joining us this week on the ETF Experience podcast. Be sure to visit us at exponentialetfs.com to join the conversation and view our show notes. If you love this episode of the ETF Experience, head over to Apple Podcasts to subscribe, rate, and to leave a review. As always, thanks for listening, and see you next week.
This Exponential Exceptional podcast is published and provided for informational and entertainment purposes only. All opinions expressed by the show participants are solely their current opinions and do not reflect the opinions of Exponential ETFs. None of the information constitutes a recommendation that any particular security, portfolio of securities, transaction, or investment strategy is suitable for any specific person.